We are navigating an investment bubble centered on artificial intelligence that rivals the largest in history. For many investors, the fact that the technology is functional and powerful serves as proof that a bubble cannot possibly exist. Historically, the most destructive market crashes form around entirely legitimate, world-altering inventions. The presence of a transformative product often blinds the public to the unsustainable financial structures supporting it. Jeremy Grantham has spent 60 years managing billions of dollars by identifying these specific patterns. His research indicates that asset bubbles reach their peak precisely when a new technology appears to change the fundamental rules of the economy. The expansion of the railroads connected continents and transformed global trade exactly as promised. The idea was powerful and the technology was real, yet the sheer volume of speculative capital poured into the industry wiped out the first generation of investors. These collapses represent a moment where the collective enthusiasm of the market loses its connection to financial reality. As a new technology gains traction, a process called emotional contagion begins. Investors watch those around them making rapid gains and move capital based on excitement, often bypassing a rigorous analysis of business fundamentals. When this cycle of hype reaches its maximum intensity, the market enters 100% narrative territory, where the story being told matters more than the profit being made. This chart shows concentrated risk. 40% of U.S. stock market growth is tied exclusively to AI. When price moves this far ahead of current revenue, the financial structure becomes fragile. Historically, such a wide gap closes through a significant market correction. Investors at this stage are betting on the shared optimism of the market, rather than the immediate viability of the underlying businesses. High valuations require a specific kind of accounting. To justify current prices, investors essentially pull 20 or 30 years of projected future earnings into the present day. Japan's asset bubble in 1989 provides a clear look at what happens when a global power reaches this level of overvaluation. At its peak, the Japanese market reached a 65x earnings ratio. This bar chart visualizes the imbalance. For every $1 a company actually earned, investors were paying $65 for the privilege of owning the stock. In the late 80s, Japanese technological dominance seemed like a permanent feature of the global economy. Investors felt that the quality and reach of products like these made the high entry price a secondary concern. Today, AI companies are spending billions on the physical infrastructure of data centers and specialized chips. This build-out is being funded by significant levels of debt, predicated on the hope that future revenue will outpace the cost of borrowing. This creates a race between the compounding interest on that debt and the actual speed at which businesses and consumers adopt the new technology. A crash often begins the moment the prevailing narrative loses its internal logic. Current AI valuations rely on the assumption that a small group of US-based firms will achieve and maintain total global dominance for the foreseeable future. The release of models like DeepSeek challenged that core assumption. It proved that foreign competitors could produce high-level capabilities at a fraction of the capital expenditure previously thought necessary. This development questioned the necessity of the multi-billion-dollar moats investors believed protected these companies. When the primary reason for a high stock price is put into doubt, the market's enthusiasm can shift rapidly. Once the narrative loses its luster, panic often follows as investors attempt to exit their positions simultaneously to preserve their remaining capital. As stock prices drop, companies lose the ability to use their inflated shares as collateral or currency. They are left facing the reality of their high debt loads without the soaring valuations that once made that debt appear manageable. Objective financial data eventually reasserts itself, regardless of how compelling the initial story may have been. The great irony of these market cycles is that the technology often succeeds in changing the world long after the original investors have lost everything. During the dot-com crash, Amazon's stock price fell by 92%. The resulting economic contraction impacts retirement funds and employment, creating a significant human cost for those caught in the wreckage. Having a correct vision of the future does not protect an investor from the immediate risks of an overpriced market. Most investment advisors will not warn you to exit a bubble because their business models rely on keeping capital in the market. Fighting a trend that is making everyone feel wealthy is rarely a profitable strategy for Wall Street. Defensive investing offers the only practical protection against the unpredictability of these cycles. In the current environment, true diversification requires moving capital away from the saturated artificial intelligence narrative entirely. This involves reallocating funds into foreign indices, bonds, and cash, assets that are not currently buoyed by the tech euphoria seen in the U.S. markets. Aligning your strategy with verifiable financial numbers provides the stability necessary to endure when the broader narrative begins to fail.